Dominic Hobson, co-founder of Future of Finance. My guest today is Dr. Jamie Walton, co-founder of Raidne, a former head of FX and rates quant at Morgan Stanley, where he started the EFX quant team in 2009. Jamie realized a lot of the models he had built at Morgan Stanley could be turned around to find trading anomalies as opposed to trading opportunities. That insight is what gave birth to Raidne, which offers buy-side users of the FX market's best execution, transaction cost analysis, algorithm evaluation, rankings of liquidity providers, ethical assessments, and surveillance tools to check for market manipulation and abuse. Jamie, thanks for joining us.
It's a pleasure to be here. Thank you, Dominic.
Now, historically, we all know that the buy side has tended to leave a lot of money on the table in FX. What exactly is the opportunity you saw, and what alerted you to it?
That's a great question. So, I guess historically, working for on the sell side for banks, my focus was always on the execution aspect. How can we trade this efficiently? But then shifting to focusing on the buy side, having the buy side perspective, I could see that actually the costs of executing were more important. So that actually led to us looking at best execution and surveillance for the buy side's benefit. And to go one step further, we went and looked into benchmark capabilities, and with clients trading a lot of their executions at things like the 4 p.m. fix for FX, how could we provide more efficient, fairer benchmarks for them to manipulate at, which could potentially lead to savings for them. So the impetus on the benchmark side was a meeting in 2018 we had with the Bank of England Fair and Effective Markets Committee. And the question came up in that meeting, why is there no competitor to the WMR fixing? I mean, there's Bloomberg Fix, but that hasn't really taken off in any big way. And that was the question that sort of sparked my interest in benchmarks in particular, and led me to develop the Siren benchmark as an alternative benchmark, which in our opinion is a much fairer benchmark and leads to better transaction results for clients on the buy side.
But it also led to the name of your organization.
Yes, so yes, obviously.
But explain to the listeners what Raidne means.
Yes, well, because I'm so good at marketing, I thought I'd choose a name which no one could spell or pronounce, which is Raidne. It's actually a Greek word meaning siren. So the idea being that it's like a warning siren, a sort of surveillance terms. And then we used the name Siren as the name for our benchmark.
I mean, Greeks, sounds mathematical too. Now, you've mentioned you started with a sell-side perspective. Obviously, you switched to taking a buy-side view, particularly after that meeting at the Bank of England. Now, as you look back over the 3 years that have elapsed since 2018, to what extent do you think buy-side attitudes towards FX have changed and they're less likely to leave money on the table than they were back then?
Well, I think the great thing is that the buy-side are asking more questions. Some of that may well be regulatory driven, with MiFID II, the requirement for best execution. That's leading to the buy side, actually asking the right questions and doing the analysis to see, how is their FX performing. In many ways, FX has always been sort of the problem shoved to the side. Equities performance is generally the primary goal. But when we do look at FX, there's a realization that potentially there's hurting overall returns just through inefficient execution. So what I've seen is just more awareness about FX, more questions about how execution occurs, and this more transaction cost analysis and best execution analysis that clients are demanding.
Now, you say that the buy side is asking more questions, but and despite criticism going back a considerable period of time now, that you mentioned the WMR fix, that 4 o'clock fix has survived. And I'm wondering why it has survived so long when everybody seems to know that actually it allows banks basically to front run transactions. Why is it still with us?
It's a great question. I think that the biggest issue historically has been the lack of a credible alternative. I think Those clients who need to execute at a benchmark, there really is only WMR historically that they've been able to use. And that means it's been built into systems, it's been built into IMAs, it's been built into other benchmarks like a MSCI World Index, which assumes WMR. So that's kind of embeddedness of the benchmark into so many parts of the process has led to this, it's a big shift to move away. There needs to be changes to the IMA, changes to the benchmarks, potentially changes to systems. I know one client who their system actually didn't allow them to change benchmark. It was hard coded to the 4PM fix. So that was a technical problem they needed to solve. So that's been, I think, one of the big problems. It's not that they don't know that there are issues with the 4PM fix, and of course there was a big scandal in 2014 and all the fines associated with collusion at the fix. So the awareness is there, but I guess the question has been, well, what can I do? What is the credible alternative?
And you've got an answer for them?
Well, yes. So we believe that Siren is that answer. So we developed Siren as a benchmark specifically to address some of the problems we know from existing 4PM fix. The window for execution for the 4PM fix, this 5-minute window, we know is too short to absorb the amount of volume going through at the fix. The liquidity just isn't there. And that causes all this market impact. The market tends to run away from the clients executing on the fix, and they get worse and worse fills. And the banks know that. So there's a tendency for banks to say, well, to avoid that, I'm going to start pre-hedging the fix. I'm going to trade before the window. And then that kind of exacerbates the problem, because you get this run up into the window, you get the fixing window itself, it continues, and then you get this retracement. And the victims then are the Buyside, who have ended up with paying more higher costs. So with Siren, we said, okay, well, this 5-minute window is not long enough. We need to have a 20-minute window so that we can absorb some of that liquidity. And we need to have a calculation methodology which is more reflective of the market. So we do that in a couple of ways. One thing we do is we use an independent source for our underlying market data when we construct the benchmark. If you think of the WMR fix, they primarily use Reuters dealing, Refinitiv dealing for their underlying data. Now we use New Change FX, which has more than 10 underlying ECNs that they aggregate in order to construct the rates, which means it's more representative and potentially harder to manipulate. If you're trying to push the fix, in theory, you have to push all of those 10 plus venues in order to cause it to move against the client. So that was some of the motivation to try to create this fairer benchmark. And the proof is in the pudding, and so this is now traded. We've been trading since January this year, and so far the clients have all had success with executing the Siren benchmark, and they've achieved better results than trading WMR. So that's very satisfying to see.
The clients have had success. An independent person listening to our conversation so far would probably reach the conclusion that your product was aimed exclusively at the buy side. Is it ridiculous to suggest that the product might have some application to the sell side as well?
Not at all. So, I mean, one of the key things that we're providing here is a benchmarking service. So that allows us to have an independent, regulated price, essentially. And so anyone who requires that independence, who wants to take out the subjectivity from the market or any accusation of manipulation, could want to have a benchmark, an independent benchmark, to justify their results. We have certainly been speaking to banks about providing this Siren package as a benchmark for the bank to offer to their clients. So it's an extension of what we're already doing. We have a benchmark that the banks are trading with their clients, and how can we extend that further and maybe extend the scope of underlying products, underlying markets that we can use it in. So yes, we are in lots of talks with the sell side. I mean, banks are keen in many ways to move away from traditional benchmarks. There's some fear associated with existing fixing. Clearly, banks don't want to have the fines associated with being accused of any manipulation. So there's this sensitivity around it. So really here we're offering a genuine dealing rate, fully transparent, that allows the banks to truly offer execution services against benchmarks.
Right. So it allows the banks to win business by offering reassurance to the clients, but it also gives the banks themselves some reassurance that on the compliance side, if you like, that it would.
Exactly.
Now, back to the buy side. Are you getting a better response? The buy side means two things, really. It means asset managers and it means institutional investors. Are you getting a better response from asset managers or from end investors, institutional investors?
It's a great question. And we are getting positive response from both. But I'd say the main drivers here are on the sort of the asset owners, the pension funds in particular, who are looking at the cost of execution and looking at ways that they can get that cost down, understandably. So we've had some pension funds really pushing asset managers to switch benchmarks on their behalf, which has been very pleasing to see. Now, to be clear, even the first trade we had for Siren was with a European asset manager. So asset managers are definitely involved in the process, and that was an innovative asset manager who wanted to move forward to find those benefits on behalf of their clients. And clearly, I would like to see more of that. One thing I would say is we have had some pushback from asset managers just because the effort involved in switching all their clients across. So we really need to see more of that demand from the asset owners, driving their asset managers to switch this benchmark. I think that will help we get more and more of a foothold into that asset management community.
Now, you've just said you've had asset managers pushing back. The term asset owner obviously covers a very wide spectrum in terms of size and capability and sophistication. How sophisticated do you have to be to make good use of the Raidne services?
I mean, to use our benchmark is you don't need any sophistication at all. I mean, it's as simple as an asset owner, a pension fund, say, calling up their asset manager and saying, I want to trade at Siren rather than the 4 p.m. fix. That's all they need to do, and that's it. I mean, the actual effort there is on the bank side. So it's the banks who builds the execution in order to deliver the Siren benchmark. So that's kind of no requirement in terms of sophistication. What I would say is that if you want to understand where the savings are, we do perform studies on behalf of asset managers and asset owners. So send us your data and we can actually evaluate what the benefits could be in switching to Siren. And we've done that for, I think, 21 funds now. And all of those funds we've shown would have benefited from moving to Siren. And that's one of our big sales pitches as well. Going sort of more broadly than the benchmark, with other Raidne services, we do offer more bespoke best execution and transaction cost analysis, and in particular the surveillance work we do. And that is a little bit more complex, but it's really designed around the clients. So clients tell us what they need and we deliver for them. I guess what we're trying to do is provide the service they require. So rather than having a one package fits all, we're delivering this bespoke solution to the client's needs and to their level of understanding and sophistication.
Now, as you say, you're offering more than one thing. And right at the outset, I gave this long list of things you do of best execution and TCA and algorithm evaluations and ranking your liquidity providers and so on. How would you advise clients to really distinguish between the products? At the high level, you can see how they all fit together rather neatly, but if you're coming to this for the first time as a potential user, how should you distinguish between what's surveillance, what's benchmarking, and what's best execution?
Absolutely. So, well, let's start with benchmarking, because in many ways that's the simplest level. So here we're just offering a rate where you can execute against a regulated benchmark, providing you with that full transparency, satisfying your fiduciary responsibilities as well. So that's a fairly straightforward thing. It's purely this is a number where you trade. It's in terms of systems, you don't need to build anything, you don't need to have anything in place, you don't need to deliver anything, you just need to have the data itself to know what the benchmark was. Going the next step into best execution, clearly there's a little bit more involvement there with understanding the trades. Trade data needs to be sent from the client so that we can analyze the trades for best execution. And here we're seeing this clearly MiFID 2 driving that requirement on the buy side, that regulatory requirement for best execution. This applies to non-benchmark trades. It doesn't just apply to, say, the Siren benchmark. Although, when it comes to Siren, clearly you should be doing best execution for your benchmarks as well. So one of the comparisons should be, well, how would I perform if I did Siren rather than the 4 p.m. fix? That is a requirement really for best execution. If you haven't done the comparison, how do you know? So best execution is that middle level, and I think for us, the surveillance is really the top end product, the more complex product, where you need a level of sophistication. To some extent, best execution is a subset of surveillance. I think if you're looking at how your execution performed, one of the questions is, well, was it fair? Did someone run me over? Did someone try to manipulate the market? And so surveillance takes it to the next level and says, well, let's look for evidence of potential front running or other forms of market manipulation or benchmark abuse. So that's the more sophisticated product at the top end. So as I say, benchmark straightforward. It's a number. There's not much effort on the client side. Best execution. Now we need some trade data. Then when it comes to surveillance, then a more sophisticated understanding of the markets really is necessary.
And the transaction cost analysis, what do you need for that?
Well, transaction cost analysis you can think of as being a part of best execution, maybe one step further than just, was it the best price? What was my spread? You can go a little bit further and look at things like, well, what was my market impact when I executed? Did I leak information when I traded? How did my algo perform? So that's really the difference between TCA and just best execution. One of the components, though, of best execution is best selection. It's not just about how did I do, but did I do the right thing? So you chose maybe to trade at 4 p.m. fix. You could have chosen to trade at Siren. So comparing benchmarks is essential for anyone trying to do that, and that would be considered a part of transaction cost analysis.
And you evaluate trading algorithms as well. That sounds a very difficult thing to do. Is it?
It's certainly a level up above evaluating single trades, but there are some reasonably standard techniques that have been taken across from equities, actually looking at things like implementation shortfall and comparing with other standard benchmark algos such as TWAP. So some of those things are relatively straightforward. It becomes more sophisticated when you're looking at the market impact for an algo, because clearly it's going to be more than just the individual trades. So that requires a degree of sophistication that I guess with my mathematical background, I hope I can offer that as a service.
And assessing liquidity providers, I have the impression there are not that many genuine liquidity providers in the FX markets these days, although you do have these non-bank liquidity providers as well. Do you have some secret sauce for assessing them as well, or is that a relatively straightforward, well-established methodology?
I think we have a bit of a secret sauce. So, this particularly when you're trading algos, if you're doing an algo with multiple banks, say on the buy side, or with multiple venues if you're on the sell side, then one thing we can analyze is your impact on that venue. And not all things are equal. So you may think, well, I want to trade on that venue or with that bank because they have the best price. But actually you may find out that on the counter side, well, they have the best price, but also they have a higher market impact. It's almost a fundamental law of finance, actually, that whoever gives you the best price will have the higher impact. So it just allows you to go one step further to analyzing beyond, am I getting a good fill? No, did I get the best overall result? So that's what the liquidity provider evaluation does.
Right. Now, this problem this FX, excessive costs of FX for the buy side in particular, is something that quite a few firms have looked at over a number of years now. Consultants and others, data providers and so on, have had a look at this one. If somebody says to you, what's really different about what you do, what would you say that it is?
In terms of the analytics we provide, I think it's the level of sophistication. So I think given my experience, one of the big ideas behind forming Raidne was, how can I use some more sophisticated analytics that I was using for transaction opportunities, for spotting things like transaction anomalies, any kind of surveillance opportunities around manipulation. Can we find anything unusual in that data? So we use some reasonably sophisticated mathematics in order to solve those problems, and I think that goes beyond pretty much every competitor I've seen in what we can do and how deeply we can analyze the code. So for those who really want to have a full understanding of their FX execution, a full understanding of what's going on, then this is something where I think we can differentiate from the competition and offer that sort of enhanced service for those clients.
And do the clients ask the sort of show me the money question? Do they ask what sort of savings they can expect to achieve using your tools? Is that a coherent question, and can you answer it?
It certainly is, and I think yes. The answer is yes in many ways. So I'll come back to Siren, but actually a story on the surveillance side. So we analysed one firm on the Buyside, and they, unsurprisingly, they were doing a lot of their volume with one particular liquidity provider because they had the best price. But we were able to show that actually they were suffering quite significant market impact with that liquidity provider, and actually switching off or switching towards other liquidity providers actually led to millions of dollars of savings just for that one client per year. So that was one example, just more intelligent choice of liquidity providers rather than just saying, oh, this is my list, I'm going to trade with these 5. And I think you can go beyond that, and I think best execution requires you to go beyond that sort of list. But I'm going to briefly mention Siren because we can quantify Siren savings quite explicitly. So we've run this performance for clients. Looking at, say, May month end, we were able to show that switching to Siren would have saved $800 per million on average for executing G10 spot. So that's that's 8 basis points on average saving for your execution. The question here then is, how correlated is the client to the fix? Clearly those savings are only there if they're trading in the direction of the fix. If they're trading against it, they're sort of anti-correlated to the market, then it won't be beneficial. And we've done the analysis for these 21 funds I mentioned, and the correlations we've seen have been between sort of 56% and 82% at the high end. And clearly the higher the correlation, the more the potential savings for the end user.
Right. So $800 per million, that's a pretty explicit measure of how much money is being left on the table, but it's still at this point a theoretical saving. You've mentioned that buy-side firms need to be more intelligent, and that counterintuitive observation you made about the bank that gives you the best price might actually give you the worst outcome. So how would you advise buy-side firms to go about, or asset owners to go about, actually turning those theoretical savings into reality? How do they need to change their behavior? What do they need to do differently? What sort of things do they need to change to actually capture those savings?
Well, the simplest thing I would advise is to switch to the Siren benchmark, do the trading. So we have seen that. So all of the funds who have so far executed have actually achieved savings with Siren. So far it's averaging over $500 a million for those clients. So these are real numbers based off real trades. So the proof, is, if you like, is in the pudding. We can do all the studies, but switch over and see, and you will see hopefully see all the benefits that I'm talking about. Now, I'm not saying all of the clients would achieve that level of savings. There are certainly some which are more in the sort of $100 to $200 per million. But let's be clear, this is a very fine market. Typically, when you're trading WMR, you may be paying $10 to $20 per million in your fee. So savings of $100 or $200 per million, we're talking 10 times your typical fee that you're paying. So these are significant savings overall, particularly if you're doing this on a regular basis and the cumulative effect of that. So that's what I would recommend. On the more the best execution side and switching the liquidity provider, again, do our analysis and then do it. See what happens when you do switch to the different liquidity providers, and we can continue, so we can provide that continued analysis of the before and after, if you like. This was your costs before, this is your costs after, and you can just see, in a very transparent way, whether that switch was beneficial to you.
Now, those transaction costs you refer to, whether it's $10 a million or $500 a million or $800 a million, those transaction costs are actually somebody else's revenues, and the bank's revenues, I suppose. Is there any sense in which the banks should be concerned or even fearful about the nature of the services you're offering?
I don't think so. I don't think so, particularly if the bank's intention is to provide a good service for the clients, because that's ultimately what we're talking about. How can banks provide the best service for clients? How can clients get the best out of their liquidity providers? So, as I mentioned before, some banks are somewhat worried around benchmark execution because of what happened in 2015 and I think it's $11.8 billion of fines associated with that now. So it's a significant problem, and so there has been a move to sort of outsource or segregate off the business. And what we're doing here is actually saying, well, you don't need to do that. You just need to have this transparent benchmark which you can execute in a realistic way for your clients. And we've had, some banks are now embracing that. So some banks are saying, we want to do that. I think it's public knowledge now. Goldman Sachs was the first bank to execute Siren. And they certainly wanted to offer this increased choice for their clients as a service. And I think from a more broader perspective, we're offering, more diversity in the market, and that has to be a good thing. We're allowing choice. We're removing somewhat an inefficiency, this bottleneck of everyone trying to execute the same thing at the same time. And we've seen a positive response from banks. Every bank has had a positive response to Siren. They've all, we've got several banks who are engaged with offering it now, and every bank has said, based on client demand, we will offer this as a service. So I no, we haven't seen that fear as such. In fact, we've seen certain banks choosing to embrace this as an opportunity.
Yeah, they save fines and they win business.
Yeah,
of course, the customers get to save money as well. Dr. Jamie Walton, thank you very much for joining us. It's been a fascinating discussion.
Thank you very much, Dominic. It's been a real pleasure to speak to you.